So starting off with technical analysis. So the one thing that's really important to understand is there's no best technical. So that is one thing that I also think is the problem with the industry that we are in today, where mentors are selling strategies. So, I mean, I'm 100% referring to ICT or SMC or all these strategies that's created. So, before we continue, just once again, a reminder, everything that I say tonight is my personal opinion and not financial advice. So, in trading, there's no strategy. If someone talks about a strategy, it should be a combination of what he has built through certain technicals. There's no best or better technical. It's always about what you see. And just by simply looking at this specific example, yeah, the session is recording. If we look at this specific example, so let's look at that third touch. Okay, that will be a trend line. That will also be a key resistance, key supply area. If you add your fib from there to there, it should be a 61% fib. It's in a bullish flag pattern. So there's so many different ways to interpret that specific trade. So it doesn't mean, can't you guys see my screen? Just let me know. What are you guys currently seeing? Hi guys. Just let me know what you're currently seeing. Dion, what are you seeing? Your PDF screen. Yeah, perfect. That's what you're supposed to see. Okay, perfect. Michael, just check. Like I said, I'm sharing. Maybe just scroll through all the participants, just click on my name and then just enlarge yeah, my recording. Okay, so there's no best or better technical. What will depend on the technicals that you will be using is the way you interpret or see the market. So every single person, and when they talk about trading as 90% psychology, it comes down to different people, different mindsets, different ways of seeing things. If you are a person that always panics or always has patience, whatever it might be, everything will be a factor coming into play of what you see, how you see it, and why you see it. So that is once again the core to building and creating your own strategy is through understanding what you see and then taking that and implementing it into the right pairs. So just like I explained in the beginning as well, just like a strategy, there's no best or better pair. It's going to be about what technicals you use and what pairs it works on, the based on. So OGSD, once again, it's a clear ranging market, always in ranges. If you are trading OGSD, you're most probably going to be focusing on support resistance, supply demand, etc. If you are trading CHF JPY, you're most probably going to be looking more towards FIB. Yeah, it does like trading from FIB, also likes trading from key psychological levels. So we can even see here, just the support level be bouncing off 116 psychological level. So straight off the bat, psychological level there. We also have the 500 psychological level there. So it does love trading from psychological level, and it's also a trending market, meaning trading trend lines. So every single market has a different characteristic to it that you will be using and implementing. So the first thing we have is support resistance. So the support resistance is very much the oldest book in the technical book. But support resistance can be seen as multiple things, from key levels to support levels, resistance levels to key buying levels, selling levels. Once again, there's so many different names to it. But the original name is still support resistance. So it comes back to 2025 traders where they're rebranding everything and all of a sudden that will be called a AVG line or something in that line. Once again, they do it because that's how they sell courses. At the end of the day, this will always be support resistance. Doesn't matter how you see it. So support resistance is quite simply supporting the market to go to the top side so that your buyers within the market. Resistance is your roof of the market resisting the market to go to the downside. So if support is broken, then support obviously becomes resistance. So it's see the market as like a four-story house. Support your floor. Once the floor is broken, you're going to the story downstairs, etc. So support resistance is placed on where does price go up or where does price go down? So although we have that spike there, price physically moves up from that specific level. Support resistance is also the art of consistency. Where does the market consistently go up from, or where does the market consistently go down from? And I always explain it in the same way. If you go to any parking lot and there's a Lamborghini, okay, that's the Lamborghini. Because it doesn't matter if there's four Ford Rangers next to each other, you won't even see it. Although even if they're brand new, because you can see a Lamborghini next to them, your eyes will already go to that. So we as humans tend to focus on the odd one out, and that is obviously where the patterns are created with the art of consistency, because we as humans are not as consistent, and that's once again where the psychology of trading comes in. So we'll be showing it in the live market just now as well. Same thing there as well. There's one spike. I mean, doesn't matter what type of human you are, your eyes will already go to that. That is just, you immediately see it, that's what it is. But price sells from there, price sells from there, price sells from there, price sells from there. So that will be our key area of resistance. Same thing here. Price buys from there, price buys from there, price buys from there. So that will be our key support area. So a minor factor that comes into play as well is where traders will say support becomes resistance. In theory, yes, but there's still a key difference between buying levels and selling levels. It doesn't have to say that support becomes resistance. A similar area, yes, but there can be key selling areas, key buying areas, and key selling areas. So in this specific instance, price obviously came back, pushed down from that specific level. So created a lower high, and that then will act as a key area of resistance. Okay. Then in theory, this is just how it looks. Once again, resistance being your roof, support being your floor. So when I started trading, like I said, I bought my first course for 10,000 Rand, and the only thing that they taught me was trend lines. So met up with the guy at the time. He was trading a hedge fund. I mean, I've spoken about him multiple times. He's also on LinkedIn. He shares his trades on LinkedIn as well. One advice taking it, because obviously he has 9 figures in his account and he has a different trading style. So how hedge fund managers use a support resistance is in this specific instance. So I spoke a lot about risk reward probabilities, etc. in lesson 1, but for a bigger institution that has the funds, they're not focusing on risk reward, risk management. Well, risk management they do, risk reward and probabilities. For example, they will see this as a clear selling trend. Okay, price broke structure to the downside, and we are looking for a sell position. So what they will do is they will identify price sells from there, price sells from there. So that is a high probability sell area due to it being a key resistance area. Price also sells from there, price also sells from there, price sells from there. So that is our 3 key POIs. So us as retail traders will obviously try and always run around to figure out where will price pull back to. Will it be pulling back to there, or there? Okay. There's obviously ways to do it. Throughout this course, you'll understand way more the most likely the level would pull back from. So what will the highest probability level be? But what they do is, due to them having bigger funds, they will obviously take a sell position. They place their stops at the top. So trade number 1 will be a 1 to 2 risk reward ratio, and they will be risking 1%. If price goes against them, they will sell again on that level, 1 to 5 risk reward ratio, 1% risk, using a bigger lot size due to a smaller stop loss, and they will sell again with the same stop loss in mind. If price pushes to the high level, they will do the same thing once again, because they're focusing on the long term of the trade. They're not focusing on making money on the same day or making money in a certain time frame. And it comes down to something pretty simple. If we look at AUD at the moment, so let's look at AUD. We clearly in a buying trend. We do have a key support level coming up, but we also do have that key support level over there and over there. So for us, we're obviously going to see how price reacts to this specific level. So what they will do once again is say, well, we're going to buy there. We don't mind running that risk taking the market into the high points. If price dips against us, we'll buy again there. For us, obviously, we're going to be looking for something in that sense. So there's multiple ways to do it. Okay. Also, if you are a full-time employee and you don't always have the time to do it, you can also drop to higher time frames and start using that exact approach. We're focusing on higher time frame trading and not focusing on having a small stop loss. So you're focusing more on probability than risk to reward. So once again, multiple ways to determine what level to monitor. Okay, so if we look on this specific chart, we obviously had this key support level over there. We also had that key resistance, which we already broke through. Like I said, support or resistance does not become support and vice versa. So most retail traders already bought there. They're going to hit stop loss and we'll wait for price to either tap into the lower level or break back above. So this is a strategy that I've broken down multiple times as well. Okay, we had this key resistance area. Okay, price sold from there, price sold from there, and price sold from there. So what is everyone going to do? They're going to wait for a buy there to run into the top side. What I usually wait for when I'm trading simple support resistance is always for price to close back below that level. And then once we close back above, I'll take a buy trade. And the reason for that is we've already had the liquidity grab, which is meaning liquidating the buyers. Then I'll take a buy position on that level, and I already know where to place my stop loss, just below that bigger spike. So that is something I do quite often. Similar example than we have now. We do have our key support level. We did have our key resistance level. So for me, what am I looking for? I'm waiting for price to close above, close back below like we did. And then once we close back above, I'll take a buy position over there and run it to the top side, placing my stop loss below that bottom spike. Once again, multiple ways to do it. That's option number one. Option number two, having a bigger stop loss, and if price dips against us, we'll buy again there, increasing to 1 to 11 risk reward. So that's why I keep saying there's multiple ways to interpret the market. You can also get to a point, if you understand probabilities and risk reward, to say, well, if price respects or rejects this specific level, which it didn't, I mean, it just closed straight below. But what you can also do is, if you understand risk reward and probabilities, you can take that buy position. If you end up hitting stop loss, then you can just enter that buy again. So there, once again, risk management plays a key factor. You lose 1% there. If that trade plays out, you make 5% back, still up 4%. Let's say you lose both, eventually end up buying from the bottom level. You lose 2% and eventually you make 6-7% back, still up 5%. And that's why I'm saying there's so many different approaches. And I mean, we're just focusing on support resistance now. But do you guys understand the concept that I'm trying to explain with just understanding support resistance is not the difficult part. Understanding what you're going to be doing with support resistance, that's the important part. There's so many different ways to interpret it, to use it, to make it something that you can understand or use in a certain sense. And the same thing that I explained with the momentum trade. We had a key resistance. We can also see in this case, resistance does become support because there's buying pressure there and there's buying pressure there. So with this momentum trade, we're looking for price to close below, whether it be that one or that one. And then once we close back above, we were looking for the buy. In the second instance, we had a key resistance area there. Price closed above, never closed back below. So what do you do there? Trades doesn't always play out. So you see that's once again where traders will say, well, this strategy doesn't work. It still works. We 1 for 1, and if this is going to break back above, we're going to be 2 for 2. It doesn't mean because every single trade doesn't play out that it doesn't work. So now once again we wasted, in theory, let's say 3 days waiting for a trade. But would you rather take 2 trades in a week and win 2 trades, or will you take 6 trades and lose 6? That is the mindset difference between certain people. So once you understand that concept, it will become a lot easier. Okay, just get some water. Okay, then factor number 2 will be supply demand. So supply demand goes hand in hand with support resistance. Okay. Once again, do you need to use supply demand? No, you can only use support resistance. Do you need to use support resistance and supply and demand? No, you can also just use supply and demand. So what we have in the market is obviously a key resistance. Resistance, once again, is placed where price goes to the downside. So the one thing we'll always see on a key resistance area is a spike to the top side. So the gap between the resistance and the top spike is where your supply or demand area is. So here we can see the only reason price went up to that point is because of a psychological level, which I'll explain just now, of 0.68. Same thing over there as well. There's our key support level. Price spikes to that level. So where does supply and demand actually become a factor? Okay, if price comes into a key demand area, demand buying, supply selling, if we come into that area, as long as we do not close below that area, it is not seen as a breakout. Okay, there we had our key resistance, key supply area. Price went up, closed straight into the zone, closed below, retested, sold to the downside. Went straight into the zone, respected the zone through multiple candlestick formations, retested, sold to the downside. Price went into the key area of demand, never closed below, went to the top side. So supply and demand is the only way for you to determine where a breakout will happen. If supply and demand is not broken, the trade will still go the other way. So just another example from there, price buys to the top side. So that will be our key support area, and that will be our key demand area. So something similar is if we look at this level, price buys from there, buys from there, buys from there. So that will be our support. And then demand, that's obviously just a gap over a weekend. So we will be looking at either that example over there or this example, and the same thing. You can also take that out as it's exactly the same thing. So that's also a little bit of a major area of demand where here price sells from there, and then we'll have that supply area due to that spike over there. So that spike, the peak of that spike is what you call a liquidity point, which I will explain a little bit later on as well. And once liquidity is broken or taken out, that means that it's a breakout. And that is why we place our stop losses above supply and demand areas. Because if price does close below that area, we want to be out of the trade because it is not coming back. Okay, makes sense? Okay, perfect. The same thing if we look at current price. Okay, resistance does not become support. The only buying level we have is over there. So that is, once again, there's no selling pressure or buying pressure yet formed. So at the moment, we only have that buying level over there, and we have that key area of demand over there. Okay, simple. Then just another example of major versus minor. Once again, higher time frame levels are obviously more important than smaller time frame levels. So over here we have our key resistance area, key supply area, key support level, key demand area. Okay. Then obviously on the lower time frames, like I just explained on USD as well, price sold from there, sold from there. So a minor resistance and supply area is formed. Once price closes above that level, what do? We move our focus to where does price buy from? So once again, their price sold from, but their price buys from. Then we're just looking for the simple retest and the continuation to the top side. Okay, and if we look at this specific chart, there is going to be our next level of resistance. So if we break through that level, then we're going to be looking at that buying pressure over there. Okay, selling level, buying level, selling level, buying level. So always look at where's the sellers and where's the buyers and try and execute based on their trades. In the market, you get what's called a selling level and you get what's called a continuation level. Buying level, continuation level, continuation level. Okay, so it's always about what happens in that specific structure. So if they have to break it down, price sells from there. Okay, so key selling level comes back up, continues from there. Hits our selling level, sells from there, continues from there, pulls back from there, continues from there. So continuation level, pullback level, buying level. Okay, from the buying level, we're going straight up. There we have a pullback level, buying level, and then from there, just straight up a continuation. So always try and interpret what is the market doing in that specific structure. Okay, from that point, price bought. Okay, we're in a buying trend. So that is not a selling level, that is a pullback level. Okay, then we have a buying level and a pullback level. Okay, pullback level and a buying level. Okay, then price goes up, comes down, and there we have a continuation level. And now actually we can identify the key continuation level. So what happens to this specific market structure? Price buys from there, continues from there, buys from there, continues from there, buys from there, continues from there. Okay, so buying level versus continuation level. And that's why I always explain, once you have a scenario like that, you don't always have to have the best entry. And the only reason traders wants the best entry is, once again, social media, where you see the word sniper entry, which once again isn't a word. So what I will always do is wait for price to hit the key buying level, respect the key buying level, and then try and get a position from the continuation level over there, placing my stops below that bottom level, and then just extending my take profit. Okay, same thing over here. We obviously know that we're in a higher time frame buying level. So what are we looking for? The key continuation level. And once again, what are we going to do with our trade? We're just going to be placing our stops below that specific point, and then obviously just extend it to the relevant target, which we'll obviously find on the higher time frames. So how will you find that specific target? Once again, just simply looking at the higher time frames. So over there and over there. And you can also interpret this specific level as well. So if you look at that, for example, you have a key selling level over there. You have a continuation level over there, break of structure, key continuation level over there and over there. So more or less, where did that sell-off start? Over there. And just like that, you know exactly more or less where your target will be for the next position. Okay, option number 1 or option number 2, if we can break back above this level, you can also place your stops below the previous low to increase the risk reward. So once again, comes down to how you want to see it or how you want to do it. Do you want to take that sell based on that, or do you not want to monitor your trade and maybe have a little bit of a bigger stop loss, and if price goes against you, just add a buy limit there and obviously increase your risk reward. So once again, that is what you guys need as a trader, need to go and figure out what works for you. There's nothing that's best or better or whatever it might be. There's always about what works for you. Or you can just simply say, high time frames I know I'm buying, so we have a low low, lower high, low low, a high low, lower high, lower low. Okay, for us to have a break of structure, we need to break through that specific point. So we're just going to wait for price to create a higher high, then wait for a higher low, and then we're going to buy the market to its upside. So exactly what we explained on support resistance, just broken down in a different market structure. Okay, then let's get some water. Okay, perfect. So just another example. Price obviously sells from there. We had a clear break of structure, so that is usually when you have news, prices obviously closes above false breakout, closes back below and continues like normal. So here we break structure to the downside. There's our support level, there's our area of demand. Once we close below, where do we sell from? Price sells from there, price sells from there. There's our spike, so just like that, that will become our key area of confluence for the sell continuation. Okay. Then, so this is basically just the explanation of why supply and demand, or how does it work, or what's the origin of supply and demand. So there's multiple terminals where you can actually access or see the orders that banks places. So usually what you will see on that specific orders, Bloomberg obviously is one of them. There's another website that I've saved. I just don't want to open my bookmarks now because I don't know what I saved everything. So for example, what you'll see on that specific terminal will basically be something in the sense of buy limit. It's not top, I can't remember what's the word. And then it will say buy limit bottom, obviously different wording, I literally can't remember. And then it will write the following. So the top price will be, it's always two prices, 63423, and then the bottom price will be 273. Okay, so that is basically what you'll read. Okay, so the bank will have two limits set in a specific structure. So why is that? Okay, so that's why the bottom point is called a liquidity point, because that is where the orders will be liquidated. Stop loss would be it. So what they will do is, once again, it's just a different form of risk management, which we'll also get into. So rather than having $100 account, obviously they'll have like $1 million account, but they will have $10 accounts. Okay, so every time they take a position, they will allocate the full $1 million, $10, whatever it might be, to a specific position. In that way, they cannot over risk on a trading position. They'll have their target in mind, they'll have their orders in place, and that is where AI comes in, or EA comes in, which will be executing trades for them in that given ranges. So what that EA will do is it will basically start buying at that key bottom low. Okay, going from there, it already has the stop loss in mind. So like I explained, if it goes a little bit lower, we'll usually have like 100 buy orders. We'll buy again, buy again, buy again, buy again, buy again the whole time, stacking buys until the last level, which is the liquidity point. Okay, that will be the last buy limit, obviously increasing the risk reward as price goes against them. And the reason for that is, if price triggers that bottom entry, they have every 1% they risk, they make 17%. So they're probably risking, well, they're risking 100% of that specific account, but if it plays out, they make 300, 400%, which is a 1 to 3 or 1 to 4. And obviously, if price closes below that specific level, they will hit stop loss, hence the theory liquidated. So once they're liquidated, price will close below the key area of demand, and then we'll have a reversal to the other side. Okay. I know that was a mouthful, to say the least. Is everyone happy? Does everyone understand what I just explained before I continue? Just gonna wait like 1 minute, so if anything that you guys want to ask. Is everyone happy? If you're happy, just throw a thumbs up. Okay, perfect. Seems like everyone's happy. Then next topic is key levels. So pretty much the same thing that I explained with supply demand. You have key levels, and this is actually something that I already explained, but I'm just going to break it down again. Major level, selling level. Price sells from there, continues from there, continues from there. Selling level, continuation level. Okay. Price sells from there. This is not a buying level. This is a pullback level. So once price reaches that level, traders will buy from there, but it's not a buying level. It's a pullback level. So once again, why it's important to determine these factors. Selling level, continuation level, pullback level, selling level, continuation level, pullback level, continuation level, key buying level due to previous market behavior. Buying level, pullback level, buying level, pullback level, continuation level, target it. Selling level, pullback level, continuation level, target it. Do you guys understand the flow of the market? So every time price goes into a certain price movement, doesn't matter once again what type of structure you trade, you can go and figure out, okay, well, this is the key buying level over there. Why do I place it there? Very simple. Price keeps buying from there, 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 there. So that's the consistency within the market. And then obviously we do have a key area of demand. Okay. After price bought from there, we obviously had a key continuation level over there. So which also opens you up to the factor that you don't need to take the best trade. Okay. Because if you're always trying to enter on the low, you're going to buy there, hit stop loss, buy there, hit stop loss, buy there, hit stop loss, constantly hitting stop loss. Rather than just waiting for the clear, you have the momentum and try and run with the trade. And once again, let me show you how many technicals will line up if price has that breakout. We have a trend line. Okay. If you add your FIB, price will break through the 61 to 78% FIB, which is seen as a breakout. There's going to be a key supply area over there as well, which will be broken. So multiple factors coming into play. There will be a break of structure. There's a lower high there. Lower high, obviously, the point to break to shift momentum. So everything is pointing towards if that breaks, then we're just looking to move up. So stop trying to get the best entry, focus on getting the better entry and try and run with the momentum. Because once the market hits a certain level, that obviously indicates that there's a possible reaction, but we need to wait for that reaction. And the same thing, are you going to sell from that high point? No, it's not a selling level, it's a pullback level. Buy, pullback level, not a selling level. So even if you have to type it out for yourself, say not selling level. Okay. So then you know when price gets there, I will not be looking for a sell because it's not a selling level. Okay. So the key thing to these levels is you can also use them to determine where to move your stop loss to break even, where to do this or that. So for example, you have this trade in. Once price reaches that first target, there's a possibility of a pullback. So you can move your stops to break even and then just keep extending your target as price goes on. So use it to your advantage, but obviously don't overcomplicate it. Okay. Then sideways market or consolidation market, that's just a type of market structure. Like I said, USD is what you call a sideways market or a consolidating market. It goes within ranges and then eventually it breaks out and then continues the other way. Then another key factor in trading, the third touch is always the highest probability touch, whether it be on a trend line, whether it be on a support, whether it be on a resistance. So if we look at this specific market structure, okay, we can more or less see low, 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 high, low, low. Another example there, we can see price broke structure, closed above. Once we close back below that level, momentum trade. Okay, could have taken the sell there, place your stop loss above, could have taken the sell there, place your stop loss above there. Multiple ways once again. Whatever works for you. If you keep hitting stop loss and price goes your way, start trading like that. Because a lot of times we'll trade from a continuation and then price will hit our stop loss and then price will go away. So that is also where you use that same logic. Okay. Then if we look at the specific market structure, point 1, point 1, point 2, point 2, point 3, over there. When 3 being the highest probability touch, this was expected to push into highs. The fact that this failed to push into highs mean there's too much selling pressure in the market, and that will also determine that the sellers will take over. And if we look at this specific trade that we buy, no, we did not buy because the sellers are ready to control because the buyers failed to push the market into highs. So that is where it comes in when I talk about logical thinking. Sometimes I look at a market and I mean, according to most people, this will be a pullback to that level and a sell. But for me, I see the opposite, just due to the logical thinking. Dollar index is selling, or just is an high time from selling buying structure. We haven't closed below the higher low, so that's the logical thinking of it. So logical thinking is the foundation of trading, which I already explained. It's key factors that comes into play that when you look at a position, you know more or less what you're looking at just due to the logical thinking factor. Okay. Then hand in hand with key levels is psychological levels. So psychological levels is round numbers within the market. Like I said, some markets respect psychological levels more than others. In 1,000-point range or 100-pip range, just as you want to see it once again, there's 4 psychological levels. 1.1,000, 250, 500, 750, and 1,000. How does it work? USD loves round numbers as well. If we look at USD, let's just go to the highest time from structures. So if we look at that key sell level over there, already it lines up with the psychological level of 1.5. If we look at that key buying level over there, lines up with a round number of 1.2. So it's just like an added factor that you can put into play. Price bought from there, round number of 104. A lot of times price will just spike to that level and then move the other way. So this comes into play as you trade. You can also see there 1.6 psychological level. So if you actually start adding all of them in, you'll see, especially on your USD, how they come into play. So if we go down to lower time frames, you'll see how they come into play. So bought from there, continued from there, continued from there, now already closed below, and obviously going into that level. Same thing with this specific level. Don't want to trade into psychological levels. So yes, we do have that pullback, 61 fib, all those things. Also moves to the 500 psychological level over there as well. But for most of the part, you don't want to trade into a psychological level. So first, we'll rather wait for the close back above and then trade to the next psychological level. Okay, so the reason psychological levels exist, just simply once again how the world is set up. We are obviously set up to see the opposite of what we need to see. So we always see 1999, or you buy a car for 699, or anything in that sense. So the market makers obviously now comes in, use round numbers to trade from because the normal mind won't see it, although you don't always understand that you don't see it. Subconsciously, we're always seeing the uneven figures. Okay. Then final thing is trends. Okay, so trends is really important. Sometimes it might seem easy, but it's not always that easy. So one thing that I can tell you guys is if you are trading with the trend, your trading will become a lot better. So just a simple example. Okay, let's just go to the weekly. Okay, let's just start at any bottom trend or whatever it might be. If we look at this trend, okay, we have the little bit of a higher low, lower high, low, 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 high. So in a selling trend, the lower high is always the point to break. So here we had a higher low indicating a possible shift of momentum. Price failed to break the lower highs, meaning it was a false higher low. Then we had a lower high there, low, low, lower high, equal, lower, low, possible shift of momentum. Are we going to buy from that? No, we're waiting for the shift of momentum first. Then from there, we created a higher high. Okay, now we have both factors in play to look for a continuation trade. On your left-hand side, we can see this key buying pressure there. And if you started buying CHFJPY there, and even just holding on, I mean, you could literally run a trade for 4 years to the top side. So it's really important to understand where you're going in the sense of market structure. So if we look at the current structure of CHFJPY, everyone that's part of the free community obviously knew that we were looking for short positions for the past couple of weeks. And it once again pretty simple. High, 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 low, high, 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 low, lower high, low, low. Okay. Then we create a higher high, a higher low, a lower high. Okay. That lower high already determined once again that we're jumping back into the selling trend. And from there, I was looking for sell positions. So based on that same logic, I was still looking for a smaller time frame shift of momentum. So just because the weekly made a lower high, I was still looking for the smaller time frames to shift momentum, and that was just a high high, high low, high high, lower low, lower high, both confirmations. Anything from there, I'm looking for sales. So every time price reaches that bottom, not a buying level, a pullback level, then low low, sell position, low low, sell position, low low, sell position. Okay, can't go any lower than that. Okay, mess that one up, but you guys get what I'm saying. So low low, sell position. Okay, now coming into today, we are sitting in a key range of support on the weekly time frame. Okay, we didn't tap into the weekly, but we already had that key level that was formed over there. So if we take that out, okay, we are sitting on this key low point. Okay, and if we look at the market structure, a lot of people it won't be too easy to see. Let me just jump down so I can show you. We do have that key lower high. Okay, so now we have an equal low, just like I explained back there at the bottom. We had an equal low, and then we had a lower high. So if price can close and create a higher high, we have a shift of momentum. If we have a shift of momentum, we're going to be looking at where does price buy from, where does price buy from, and then see how we can run a continuation and then just keep taking it back the top side. So eventually just following the trend over and over and over again. The key differentiating factor with trends is the fact that there's a daily trend and a weekly trend and a 4-hour trend and a daily trend. That is where a lot of traders get confused. So that's why for me, I'll always get the higher weekly and daily trend. I'll use anchored text, and then I will say weekly selling, and I'll say daily selling. So do not add possible turnaround level or possible shift of momentum. That hasn't happened yet. For now, we're still selling, and our highest factor is that we're going to wait for a pullback to that level to keep selling. And it's a simple logic of if you just keep following the trend and stop trying to figure out where price will turn around, you'll probably end up being more successful than always trying to pick out the lows and pick out the lows. Because if you had to pick off the lows, they would have hit stop loss. Okay, they would have hit stop loss, would have hit stop loss, would have hit stop loss. And now it comes back to the same mindset that I already explained, where price closes below our key area of support. Okay, close back above, and then once we close below, we're looking for a short position. Okay, then we form another area of support over there, close below, close back above, short position. There, close below, close back above, short position. Close below, close back above, short position. So close below, close back above, short position. So once again, what am I explaining? There's multiple ways to do it. It's not just one specific way. If you're trying to figure out if price will sell from this level, okay, we can say that we had that low point over there. So we can wait for price to close back above. If we do close back below, we'll sell. If we fail to close back below, we're going to look for a shift of momentum. So it's always about how you interpret what the market is giving you. Okay, then it's pretty much it. This is a weekly trend, daily trend. Remember, on the weekly, it's going to be a pullback. On the daily, it's going to be an uptrend. And then just a simple explanation. So exactly what I showed you guys in the market. Low, 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 high, low, low, equal lower high. Once we create a higher high and a higher low, obviously shifting momentum. And just a simple explanation once again, low, low, lower high. Lower high, always the points of break. Triple bottom, equal low, low. Are we buying there? No. But we already know that we're not looking for a sell there due to the triple bottom. Then we have the high, high, buy from the high, low. Same concept as well. You can try and get the higher low, or you can say there was a previous lower high, close below, once we close back above, take the momentum trade. Okay, and then you just keep following the trend. And that's it, guys. That is the trade. There's a few more examples. Like I said, towards the end of this, I'll obviously be sharing the book with you guys as well, and then you guys can go through it. So in the next phase or the next class, I will be showing you guys what people today call smart money concepts, and just explain to you how it is just a simple market structure rebranded as smart money concepts. And I think just that simple sentence should show you how careful you should be of just buying or jumping into things that sounds fancy. Because if you look at what I just explained to you, high break of structure, high high, high low, high high, high low, smart money concepts, they will call it, break of structures, low low, low high, side to the downside. Same thing, just branded differently for some specific reason. There's our fib, there's our psychological level, there's our key resistance area, there's our supply area. Everything exactly the same, just branded different.